Welcome back, Focus Learners. In today's explainer, we're tackling a massive shift that is happening right now behind the scenes of the entire tech world. You know, we constantly hear about the absolute latest, greatest chips powering artificial intelligence. But today, we're exposing the true, hidden bottleneck of the AI revolution, and that is physical power infrastructure. So let me just throw a question your way right out of the gate. What is the one problem AI cannot solve with software? Take a second to really think about it, because we usually tend to think of AI as this infinite digital resource, right? Something bounded only by complex code and processing chips. But here's the kicker. AI needs electricity, and increasingly, it needs an absolutely staggering amount of it. The reality is that training and running these colossal AI models requires immense physical infrastructure. We're talking data centers that demand massive power distribution, highly specialized electrical equipment, super intensive cooling, and incredibly robust backup systems. Here is our roadmap for today. First, the power bottleneck. Second, what Schneider sells. Third, the picks and shovels play. Fourth, beyond data centers. Fifth, the bull and bear case. And finally, number 6, the final verdict. Section 1, the power bottleneck. Why AI data centers are power projects. Okay, let's dive into this. Building out AI requires massive physical infrastructure. These aren't just software hubs anymore. Today's data centers are full-blown power projects. And that's where Schneider Electric comes in. They're a major European player based in France, operating right in the industrials and electrical equipment sector. Now, for US investors, they actually trade over the counter. But the big takeaway here is that massive 5-star rating for AI exposure, because their core business of energy management and automation drops them right in the absolute center of this boom. The overall strategy right now? Buy on a pullback. And we're going to explore exactly why that is. Section 2. What Schneider actually sells. Hardware, software, services.
So what do they actually do? Well, Schneider is basically a business that helps customers produce, distribute, and control electricity way more efficiently. Because, electricity isn't just something you plug into a giant server rack. It requires incredibly complex power distribution, switchgear, circuit protection, uninterruptible power supply or UPS backup systems, and constant heavy-duty cooling and monitoring. And what makes this such a sticky business model is that Schneider takes all this physical hardware and pairs it with digital energy optimization software. That creates intensely high customer switching costs. Once a client is in their ecosystem, they're pretty much locked in for the long haul.
Section 3. The picks and shovels play. Capitalizing on the AI gold rush. To really wrap our heads around Schneider's position, we need to frame it with a classic historical analogy. A picks and shovels play is basically an investment strategy targeting the underlying tools and infrastructure an industry needs rather than trying to guess the single winning final product. Just think back to the actual gold rush, right? The most reliable wealth wasn't made by the prospectors blindly hunting for gold. It was made by the clever merchants selling them the picks and shovels they literally needed to dig. And this brilliantly illustrates exactly how this works in our modern AI gold rush. Walk through this logical progression with me. Let's say 5 AI companies are aggressively competing for market dominance. Step 1, they battle it out. Step 2, company A wins, company B loses, and company C just completely disappears. But then look at step 3. Literally all of them still need electricity. Data center operators absolutely still need power management. By supplying the critical infrastructure, Schneider benefits no matter which specific AI software model ends up winning the race.
Section 4. Beyond just data centers. Global electrification and smart factories.
Now, let's zoom out for a second, because this story is honestly way bigger than just artificial intelligence. Global electricity demand is surging everywhere. We're talking about a world pivoting hard to electric vehicles, massive population growth, and heavy industrial electrification. Schneider's products are already deeply embedded in buildings, hospitals, the smart factory revolution, commercial facilities, and major utilities. This kind of vast market diversification is incredible. A sensor that optimizes power in an automated factory makes this company so much more resilient than a pure-play AI supplier. They are basically capitalizing on the fundamental reality that our world just needs more power and more efficiency everywhere. Section 5. The bull and bear case. Objective market analysis.
Look, we're here to explain the thesis, not to push a stock on you. So let's take a completely impartial, objective look at the situation. Let's contrast the two scenarios. Over on the bull case side, Schneider is this ultimate global electrification compounder. AI spending goes up, grid investment rises, margins expand, and free cash flow just keeps increasing. It's a very enthusiastic upside. But grounding ourselves in the bear case on the other side, we see the very real risk of multiple compression. If AI spending suddenly slows down, or global manufacturing weakens, or competitive pressures in the Chinese market rise, that compounding growth could hit a brick wall. Which really brings us to a fundamental investing truth. A great company can still be a bad stock at the wrong price. The biggest risk here is definitely not that Schneider is a bad company. The risk is that extreme, sky-high investor expectations are already priced in. If a company's earnings grow by 10%, but investors were fully expecting 20%, that stock is going to fall even though the underlying business is actually growing beautifully. So let's look at the risk scorecard to see how this all shakes out. Even with strong and very strong fundamental drivers in data center demand and electrification, the overall risk sits at medium-high. Why is that? Well, it's driven entirely by that red high rating for valuation, combined with those orange medium-high risks tied to a potential AI spending slowdown and intense domestic competition over in China. Section 6, the final verdict, the investor scorecard as of August 23, 2026. Let's bring it all together and deliver that final verdict we promised at the start. Checking out the overarching metrics, it is hard not to be impressed. Flawless 5-star ratings for AI exposure, electrification, and global diversification. The long-term growth thesis here is just pristine. But, you can see how that 3-star valuation kind of tempers the overall profile. It's an amazing business, for sure, but it is clearly not a cheap one right now. Still, even with that valuation headwind, the overall score lands at a highly impressive 9.4 out of 10. That just goes to show that the foundational business is truly exceptional, positioned literally right at the intersection of the world's most critical megatrends. So the crucial point is, how do you actually act on this? Here is the exact strategy breakdown. You're looking at a buy trigger only on a 10 to 20% pullback when that valuation improves. You hold, as long as the electrification and automation growth fundamentals continue delivering. You definitely watch closely for shifts in data center orders, margins, and the situation in China. And your trigger to sell would be if orders actually collapse or free cash flow heavily deteriorates. We're going to leave you with this final provocative thought today. The AI revolution has a new bottleneck, and it is power. Physical infrastructure is the ultimate limit to software expansion. The world isn't using less electricity, it requires massively more of it, and it needs it managed far more intelligently. So as you look out across the tech landscape, you have to ask yourself, are you only watching the software prospectors, or are you paying attention to who is actually selling the picks, the shovels, and the power grid? Thanks so much for joining today's Explainer. Keep those minds focused, and we'll see you next time.